Good afternoon, everybody. Welcome to Wise Tech for Wise Money, where we speak with experienced financial leaders, entrepreneurs, investors, and market professionals about how technology, data, and real-world experience are shaping the future of finance. Today, I'm joined by Alex McIntyre, an asset manager with more than 30 years' experience across global markets. Alex has worked on the sell side with major institutions, spent nearly a decade with behaviour investors, and is now preparing to relaunch his own hedge fund. What makes this story especially interesting is that Alex's fund is not being built around a new idea that appeared yesterday. It is being built around a long-established equity research source code, a quantitative model with decades of market history behind it. So today we'll be talking to Alex about his journey, how the fund came about, why he believes this model is different, how it works, why it may have an edge over the competition, and what the future could look like for investors, markets, systematic fund management, etc. Alex, it's really good to talk to you. It's good to have you on the show. Welcome to the podcast.
Thank you, Gary. Glad to be here.
Alex, let's start from the beginning. Like you've been around a long time, like myself rather. You've been around a long time in the markets and you've seen a lot of changes. Tell me, how did it all start? How did you get into this and what led you to today?
Well, my foundation years started off with Ackroyd and Smithers. Some may or may not remember that name, which became S.G. Warburg's, that everybody knows, as a market maker, jobber, prop trader, whatever you want to call it. And then I moved to Lehman Brothers and worked both in London and New York, also on a prop trading desk. So that gave me the foundation for the rest of my journey through the industry.
Tell me, what was it like back in the day, before all this technology, working for shops like Ackroyd and Smithers, before Big Bang, etc.?
Well, my first day actually on the market floor, because initially you do your apprenticeship in the back office, learning how everything is settled, trades are settled and so on. Well, on my first day, my boss said to me, he says, to succeed in this industry, you need 70% common sense, 20% skill and 10% luck. So I took that with me, and even today that is still holds true, I think.
Are the percentages correct?
Maybe the 20% luck and 10% skill.
Yeah, we all say that successful people are lucky, but you make your own luck, but you do need luck.
Yeah, and the common sense, and in LinkedIn these days, I think the more mature generation, they say, what do you need to succeed, or what's lacking in today's world? And most will say common sense is the answer.
I think you're right.
It was an incredible period, and I feel really blessed and lucky to being part of the single capacity market, with jobbers and stockbrokers. Every day was different. Doesn't matter how bad the night was before, or the travel to work in the morning. It didn't really matter, because there was a buzz on the trading floor. There were nearly 1,500 people there every day trading. Every day was different. So it taught you a lot. I mean, I was in my early 20s, and so it taught you a lot about life as well. But what I think one thing that really I can take away from it going forward is obviously staying calm under market turmoil, and secondly, when you're jobbing or trading, I don't look at the amount of money that we're trading. You look at the amount of profit or loss. If a stock moves 10 cents or 1 cent or 1 penny or 10 pennies, you look at it that way. Is the loss £1,000 or dollars or 10,000? as opposed to some jobbers or traders that I've seen over the years. They just look at the amount of capital that they've committed and then panic. And it's the wrong way to look at trading, in my opinion.
You moved, from Ackroyd and Smithers to Lehman's and Warburg's, etc. Obviously, Big Bang was a big thing. At what point do you think the market started to really change?
It was, I think, at the Big Bang itself, really, when the British government wanted outside investors, or told the London Stock Exchange to allow outside investors. And so the European banks immediately started buying up stockbroking firms. And then the Americans piled in, and everybody was bid up, as it were, especially ex-jobbers or market makers. But it was the Americans brought that hire and fire culture with them. So we had Big Bang, and then 3 years later we had a crash. A lot of those that moved from the traditional houses like S.G. Warburg's left wanting, and the whole culture changed overnight, really, because prior to that, you got a job at Casino, for example, in the post room, and it was a job for life. And I know people that have worked at Casino right from the bottom, right up all the way to director level. And there was loyalty in the industry, to a certain extent, obviously, but there was loyalty there. But once the foreign banks came in, that loyalty just left overnight. So you get huge turnover in staff these days, and it doesn't. It's not good for cohesion, and it's destroyed the whole ethos, I think.
Yeah, I agree. You then moved on to Aviva Investors. How different was it working for a company like Aviva?
Well, the culture is completely different, because now I'm on the buy side, as it were, having spent prior years on the sell side. And it's a lot, not slower, but a lot calmer, less frantic. Fund managers sitting there and quietly analysing stocks and their portfolios. So very little noise. So whereas you come from a trading desk like Lehman Brothers and everybody's screaming and shouting, and a trading room in New York, which is the size of a football pitch almost, with an awful lot of noise, doesn't go down well on the buy side. Everybody wants to be quiet because they're busy analysing stocks and positions and portfolios. So the culture is very different. But what surprised me more than anything is you spend your life on the buy side talking to your sales trader at the investment bank. But the sales trader, having spent 20 or 30 years in the industry, knows very little on how the buy side or the investment side works. And somebody that's spent their whole life on the buy side has no idea how the sell side works and how sales trading works and trading desks. I find that very strange, because you spend more time with these people than you do with your family. But one side doesn't know how the other side works. So I had took that advantage of understanding both sides. So when I'm talking to a sales trader when sitting at Aviva, it made my life easier, having had that experience on how to get trades done, transition trades, big portfolio trades. I'm speaking the same language to my sales trader or my prop trader.
What were the biggest lessons you learned in those early days?
During Aviva?
Yeah, generally.
Yeah, well, I have not so much a lesson, but to me it was a way of investing. While I was at Aviva, they were already starting to go passive and indexing a lot of their UK funds. And I saw a lot of momentum trading, which I personally sort of feel very scared about, because that can change quite quickly. So it was, and of course, a lot of the time, on the buy side, Aviva's pension funds, they never sell. They buy stock and just hold it forever. Whereas, to me, I know you can't trade your positions that much because of the laws and the regulations, because too much trading would be deemed as churning, and the pension funds can't do that. But the markets don't go up in a straight line. They have their ups and downs, and you can enhance your portfolio by maybe trading 10 or 20% of your holding, maybe taking a profit when the signals are right, and then buying that stock back at a lower level. But that culture wasn't there. I didn't see that at all. So for me, that's when the seeds were sown, when I felt I just needed to start my own business, my own asset management business, however small it was, to try and actively trade and alleviate this blind passive or ETF trading, which of course has proliferated over the last 10, 15 years.
What I don't understand, and maybe you can tell me, having been there, I come from a trading background like you and a broking background, sales background. What I don't understand is why the pension funds are not allowed to hedge. I mean, it just seems today, with all the derivatives and tools available, why you have to take those losses.
Well, I mean, they can hedge on the basis that if they index everything and then they just write a index future against it, and then everything's egalitaire, as it were. But I understand what you're asking. I suppose when you do bring in hedging into a pension fund environment, immediately margin comes into the equation, and that's that's something that pension fund risk departments just wouldn't allow, and certainly the FCA, I would say, wouldn't allow it either. The mutual funds in the US are allowed to hedge probably about 30% of their assets under management, but that's a cap, because any too much volatility obviously is not what they're there for. They're there for people's insurance policies and pensions to mature when they come to retirement age, and they really just can't be too reckless or deemed to be reckless in managing the portfolios.
Moving on to how the markets have changed and the changes we've seen. Obviously today the market is much more data-driven, electronic and systematic. Has that changed and the technology improved the market, or has it taken something away?
Well, the technology, as you rightly say, the technology has improved exponentially over the last decade. But of course, with that comes trading for retail investors. And as we know, the CFD providers by law have to put in bold letters on the front of their websites that 90% of retail investors lose money. But the leverage that they can take 10, 100 times, 1,000 times, I've seen some platforms. I mean, it really is crazy, because when the markets do whipsaw around, margin calls becoming more and more apparent or happen more often. So although the technology has increased or enhanced, to me it's created unnecessary volatility, because nowadays you see daily swings in stocks, individual stocks, 10-15% swings. I mean, it wasn't that long ago when that was a year's profit for a fund. or for a portfolio. But nowadays, it's down 10% one day, up 15 the next. So, I mean, you can get a 25% intraday swing in a stock without blinking. It really is. So to me, that's not improvement. I've had it said to me, sorry, yes?
No, I'm saying that the retail investor, that's got to make them 100% losing money, isn't it? Who swings
Well,
like that. I mean, how does a retail investor make money?
Well, I was being polite. Well, it's difficult, especially when they're not told or taught, what the margin call is all about and how it happens. And by definition, if they're taking so much leverage, it means that they probably haven't got the money for the margin call. So they just get sold out, and that's it. And so you get these swings, and a seasoned trader, professional, sophisticated trader, ex-jobber, if you like, can spot these swings and pick them off, as they happen. But although the technology has advanced dramatically, human nature hasn't. And many times it's been said to me, especially from the US, well, your returns from 5 years, 10 years ago mean nothing because the markets have moved on now. Well, the way I see it is the markets have actually got worse, but human nature hasn't changed. Fear and greed, get me in, get me out. That goes back to the 1920s. It's still the same. As long as human nature moves the markets as they do, then we'll get more and more volatility, which to me is not a good thing.
I wonder if systemized programs and robots will actually eventually take away some of that volatility.
It has been suggested. Every now and then I have a bit of a fight on LinkedIn when people talk about Bloomberg. Bloomberg's dead, analysts are dead, it's all AI now. So I push back a bit. One particular example, one guy said Bloomberg and Goldman Sachs analysts are dead because the time it took me to make a smoothie, I produced a report on Tesla, which would take a Goldman's analyst 6 hours to do. So I said, well, your 60-second report on Tesla, produced by AI, what does it tell you that the Tesla valuation is? Is it, if it's trading at $300, is it worth 200 or is it worth 400? So the response came back, says, oh no, we don't give a valuation. So what's the point? That's the whole point of an analyst, to tell you whether the stock's a buy or a sell.
Yeah.
So he said, well, let's look at our research like a Formula One car. We'll build the Formula One car, but a human's still got to drive it. So to me, that's just a complete nonsense and just a waste of time, really.
I think it's good that it can speed stuff up, but when you do a research paper yourself, you actually understand the intricacies of everything. If it's done for you, you actually haven't been through those intricacies. So your understanding is actually very superficial.
Yeah. We had, I had the same banter, should I say, on LinkedIn with algorithms that are pumping away all day long, being on the best bid or the cheapest offer for a nanosecond, then moving down, up and down. And somebody complaining about the intraday volatility in stocks, and somebody said, well, it's the algos. So I commented, well, algos are actually programmed by a human being. It will be 10% of the volume or a third of the volume, or be, I always remember one of Credit Suisse's, God rest in peace, Credit Suisse, but one of their algos was called a gorilla. And it was literally get me in and don't stop buying until I'm complete. I mean, it was fantastic to watch. And I said, well, humans program the algos. So there, of course, I got absolutely shouted at on LinkedIn. Well, it won't be long before AI is producing those algos. Well, it may be so, but up until now, it's a human that's doing it, and that's what's creating the volatility.
And even with AI, I do a lot of AI stuff. I mean, it still needs to be trained by a human. So it all leads to the same conclusion that the human is still very important. Going back to what you said about Aviva and when you left there, it made you realise really you wanted to be in your own, set up your own fund, you wanted to be in control of your own risk management, etc. Tell me, how did then you get from that part of your career to setting up a fund? Can you talk me through that and then tell me to where we are today?
Yes. Okay, so at Aviva, when I saw the way the portfolio managers were trading, I felt I needed, in my own small way, I needed to do something about that. So it sowed the seed that I definitely wanted my own asset management business or hedge fund. But to do that, I needed an edge. Can't just be in the pool with everybody else. And so I spent probably 5 years with this vision, but without finding the edge. And then I travelled to South Africa on business, and I had a chance meeting with a team of equity research analysts. They're an independent equity research provider. And at that meeting, after I'd seen their research and how it worked and who their clients were, tier 1 pension fund clients, for example, and hedge funds, I immediately realised that this was the edge that I'd been looking for 5 years. And I said to them, well, clearly, because they'd been in business for 20 years, and they have, because everything's automated, they have raw data that they've captured over the decades, and they know how much money the clients have made over the years on the back of their trading ideas or trading alerts. So they know how strong the source code is. So I said, well, why don't you run your own money? And the simple answer was, well, we're too busy doing our research. But if you want to launch a fund with our research, be my guest or be our guest. So that set me on the journey. And it took another 5 years to get to launch, because first of all, you've got to work out where the fund's going to be domiciled. Obviously, you've got to find the investors, but you've got to get the infrastructure in place. And if it's an offshore domicile, then you need, the fund needs an administrator in that domicile. Those don't come cheap. And you need a private placement memorandum, a PPM. That runs into thousands to get a lawyer to write that. Obviously, you've got to have your FCA. If I'm sitting in London, I need my FCA registration. Need a trading platform, fund custody and administration. So there's a lot to do before you can actually start trading, and that took me a while. But that's how, and seeing the research and how strong it was, and over the decades how it performed, that's the basis behind my fund today.
So what's the fund called, Alex?
We are the Christo Fund. We use a equity research product which I mentioned called Value Quick Analytics, who are based in South Africa. The Christo Fund is a Gibraltar registered entity, and we're in the process of relaunching, because unfortunately those 5 years leading up to launch, I launched in the last quarter of 2019, and then I travelled to South Africa for Christmas in 2019, and then early 2020, still in Johannesburg, COVID broke. So I was pretty much stuck in Johannesburg for 2 years. I could have travelled back to London on an 11-hour flight with a mask on and PCR tests every 5 minutes, and then in London in a 2-bed shoebox, not being able to move. But of course I couldn't go and see clients. So I pretty much stayed in South Africa. But the problem was, I could have as many Zoom calls as I wanted, but if an investor's going to give me their money, they want to look me in the eye and shake my hand, which was just not possible. Unfortunately, I had to give the funds back to the clients because the running costs were just outstripping the management fees.
Relaunching, what type of investor are you designing the fund for?
We're aiming at sophisticated, professional investors, individuals that is, but also corporate, fund of funds or other hedge funds, maybe long only as well, but that's probably further down the line. In the last year and a half, I've had many meetings in networking events in London, family office events with ultra high net worth clients. And one common theme that continues to come through is how the family office, or certainly the succession coming through in the family offices, are fed up with their asset managers not taking enough risk. They're effectively indexing everything. Because of volatility, they're too scared to really sort of stand out from the crowd. They don't, you're as good as your last win, and then that's it. If you lose money, everybody wants to know why. So, and the proliferation of ETFs meant that that's where a lot of the money is going. So, and the problem is there's less and less quality research out there now, which is, I think, a legacy of MiFID II, which happened, a few years back. So there's this complaint that the asset managers are not taking enough risk. And I've had meetings with the big prime brokers in London, like Goldman Sachs, Morgan Stanley and UBS, and they have a mandate to look out for emerging active fund managers that have an edge, because there is a real demand. But I'll be targeting those prime brokers, for example. But obviously, it's very difficult. You've got to start off potentially with a professional clients who can small investments into the fund, and then I can build the track record.
Tell me about the source code. What's the core advantage?
Well, the code was written in the mid to late 80s by my colleague, who can only be described as a mad professor. That is, his source code is his life. That's all he ever does. Besides, it's his source code and Tottenham Hotspur, bizarrely, are his two passions.
Good man.
Yeah. So what it is, it's a closed, systematic, fully automated, quantitative equity research product that calculates the key value drivers of an entity based on the extrapolation of historical trends. That's the official line. So what we do is, when we analyse a stock for the first time, we take 5 to 7 years historic financials of the company. We load those audited financials into the source code, and we re-engineer the financials and dig dig down deeply into the balance sheet of the company to look at the financial health. And with that, we produce the valuation. Now, the valuation on its own is not enough. We have many layers. We have the 7 key value drivers, and then a 6-factor conviction level, unsystematic risk grading, and it goes on. I won't go into the details now, but with that, the valuation on its own, I've spoken to many fund managers who said, well, we've looked at, with their fundamental research, we've looked at a stock, we love it, and it's down 20%, so we bought it. And we were watching it, so we bought it. And then it's down another 20%, and they don't understand why. So it's all, everything's about timing, as we always say. But what we've done, which we like to think sets us apart from the crowd, is that we hardwire the momentum indicators into the source code. So because a stock... I'm jumping ahead. So the Bollinger Bands, 50-day moving average, RSIs, MACD and so on, they're all hardwired into the code. So we know a stock, say it's been drifting for a few weeks or months even, and then eventually it becomes, as what we say in our buy zone. So it's ready as a buy. The valuation is there. It's been oversold. But you never know how much further the stock's going to drift. You don't know what orders are in the market. So those momentum indicators protect us from the falling knives, as it were, or the asset value traps. So as soon as the momentum turns, and we say we have 2 days of higher highs on the close, we know that the market is an outright buy, because it may have drifted for months for whatever reason, and then once it turns, how quickly in the markets these days things can move really quickly. So we know we can go in there, it's an outright buy, and 10% or 15% can be captured in a week almost, or 2 weeks. It's really quick. And the thing is that with the ETFs nowadays, the lazy investing, probably because of the lack of quality research, is that, say, the banking sector is out of favour globally, and everybody just sells a banking ETF, and then we'll wake up one day and our source code will say there'll be about 5 or 6 buys on the banking stocks, or strong buys, or buy zone, should I say, simply because you've got a basket of 10 or 15 banking stocks in the ETF, but not all of those stocks are bad stocks.
It's dragged down the good ones.
Yeah, the good ones are getting knocked with the bad ones, getting dragged down with the bad apples, as it were. So we're just picking off the quality stocks because of the way the markets are investing these days. So that's the basis behind the source code.
No, it makes sense. But can I ask a question without being awkward? A lot of people look at Bollinger Bands. A lot of people look at moving averages and buy zones and momentum trades. What makes the source code so particularly good compared with what I might see when I'm looking at all my charts with Bollinger Bands and I've got my buy zone? What is the source code going to pick up that I can't see?
Well, with all the momentum indicators and so on, don't forget we've done a deep dive into the valuation of the business and the balance sheet. More importantly, the cash conversion ratio, which is to us, if not the most important ratio. NAV, the relationship between ROIC, WACC, NAV. I can give you an example. We've seen a stock that increases its earnings by, say, 10% per annum on average for 10 years. So over 10 years, the earnings have increased 100%. But over that same 10-year period, the debt of the company has increased 450%, as opposed to the earnings of 100%. So clearly something's not right there. Two things can only happen, is that they cut the dividend or they have a rights issue. And in the particular example I'm thinking of, when we're telling clients, pointing this out, they say, well, you're talking nonsense, because we're talking to PE investors, not free cash flow quantitative investors. They say you're talking nonsense, and 6 months later the company announced a $10 billion rights issue, because the directors are not going to cut the dividend, obviously, because they want their earnings. So that's it's taking the deep dive down into the balance sheet, which is coupled with the momentum indicators that we feel makes the difference, because the PE investor is just looking at price-earnings ratio. I mean, during the dot-com bubble, the price-earnings ratio was just so ridiculously high that everybody started looking at PEG ratios, price-to-earnings growth, just to make it look more normalised, which was a massive red flag then as well. And we always say that even the world's greatest wine critics are swayed by a label. They see a stock, it's a great tier one stock. It's been going for years and everybody loves it, but not necessarily healthy underneath in their balance sheet.
So all this information, is it automated? So you get, obviously your buy signals, etc., from the charts and graphics, coupled with the balance sheet information, all supplied to you all at the same time, or do you have to read it and interpret it?
No, it's all fully automated, and this is what we're actually going through at the moment. We're going through a major IT programming upgrade to the back end upgrade to the automation process. So the system produces a daily spreadsheet every morning, say of the FTSE 100 stocks that we cover, plus the 120 South African stocks. So a spreadsheet for each universe, as it were. So say, for example, the spreadsheet of the FTSE 100 stocks comes out every morning before the market opens, using the closing prices of the stocks the night before. And it will tell you exactly where the stocks are sitting, whether they're in the buy zone or sell zone, or outright buy or outright sell. And all of what I've explained is all automated. So all of that is done. Obviously the source code that took years and years of building and enhancements is doing all the heavy lifting in the background.
So what's interesting to me is that a system devised in the 80s, which is like a lifetime ago, is so appropriate and going to be so accurate in 2026.
Well, ironically, selling the research, 10 or 20 years ago wasn't easy until the client finally got the click, as we say, in their head of how strong the research was. And of course, every pension fund manager, every hedge fund manager, every investment bank analyst have been doing research for years and have all got their own ideas, their own models. So when we come along, especially to the investment banks, we're seen as a threat. Because of the automation process, one analyst can comfortably cover 150 stocks, whereas an investment bank analyst probably might cover 40 or something. So we have that advantage, but we always said we're not in competition. You can use our quant type model as a sanity check to your own fundamental research. So we try and work with clients, but once they got the click, and once we'd launched to the markets in 1998. Immediately, we captured tier one pension fund clients. Our first client wanted exclusivity because they could see the edge, which they had for a year, but then we wanted to, they released us after a year, but still remained as a client. But then immediately we captured more tier one pension fund clients.
So, in reality, if I was looking at this as someone who wants to raise money, all these clients that bought the research, obviously realise, about the edge, they should be really the first investors into your fund.
Well, yes, thank you for summing it up perfectly for me, Gary. But as I was sorry, I digressed a bit. But as I was saying, that ironically now, our source code is what everybody is trying to create using AI. 20 years ago, nobody knew they needed us, but now they do, and we're almost becoming more relevant now. A lot ask us, are we an AI product? Well, I suppose you could argue we're AI styled, but I wouldn't say we are, but everybody's trying to create what we spent 40 decades creating, and you can't do that overnight. It's just impossible. Years and years of raw data. Okay, you can capture that data. It's there to be downloaded or whatever, but the human nature in the markets is still what drives the emotion, the political rhetoric, the geopolitical shenanigans, which creates all this unbelievable volatility at the moment, which I don't think that AI really could ever capture correctly. But the whole thing about the source code is that we cut out all emotion. It's purely driven on the financials of a company and the strength of the balance sheet. So markets can be moving up and down all over the place. Total carnage sometimes, but we're just focused on our source code and where the stock is at that particular time. Ask Jim Simons, the late Jim Simons, he will tell you the same thing.
Well, it makes sense, because if we just take it in a small, minuscule part of time and we see a figure like non-farm payroll or, Trump bombing Iran, we'll see a move in the market based on that sentiment. And then, within 20 minutes, it will calm down and people will start to buy value again. And the market will correct and go as it should. So the source code is amplifying exactly what the market does by eradicating the concern about the sentiment and dealing with the facts.
Yes, that's absolutely right. And as an ex-market maker, jobber, trader, whatever you want to call me, sitting on your hands is the most difficult thing. And there's so many traders.
Because you're born to trade.
Yeah, and there's so many traders out there that just have to be involved.
Yeah.
And the majority of the time, those are the worst trades, really. You just got to sit on your hands, wait and be patient, because most of it, our source code hit rate has been captured by an online tipster platform in the UK, and our hit rate is over 70%, about 76%.
That's amazing.
As a trader, okay, you can trade in and out, but if you can get 70% right, well, quid's in. But if you can get 51% right, you're still making money. But it's a lot of stress for maybe small returns.
So is there more money to be made for the investor and the company by creating a hedge fund? Or is there a lot of money to be made by leasing out the source code?
Well, over over the years, obviously the model has been leasing it or providing the research to clients on a monthly subscription basis. Typical independent research provider model. But what we want to do now is bring that source code back in-house, and we would use it purely for the fund. Now, another strength of the source code is that it can load any stock in any country around the globe. We currently cover, as I mentioned, the FTSE 100 and about 120 South African stocks, but over the decades, our pension fund clients have asked for many ad hoc valuations. Over the years, we've valued Japanese stocks, Asian stocks in general, S&P 500, European stocks. So what we plan to do now with the fund is that we'll probably load the S&P 500 next, because that's on everybody's lips. The Mag 7 or the tech sector overbought, is it like 2000 all over again? So we'll load that and the S&P 500, and we'll be able to tell you straight away whether the market's overbought or not. And then we can load other markets like Europe and the DAX, the CAC, whatever. And then every time we load a new universe or market, we'll launch a fund on the back of that research. So we'll have multiple funds working with the research, automated research, producing these automated daily trading calls. And over the years of back testing, we found that the research produces trading signals probably on average about 2 to 3 times a week. It's about 100 to 120 times a year in each universe. So we know how much we'll probably be trading. Over those testing years, returns have been on average about 6.8% per trade, and our holding period has been about 62 days. That can be anything from a week to 3 months, depending on the volatility at the time.
Well,
sorry, yes.
No, go on. No, sorry.
So that's why we're doing this big back end upgrade to the automation process, because we're going to be very busy in the future loading new markets and creating new funds.
Well, what's interesting to me is that a lot of funds, when they launch, they've got a simple 3-year on paper track record. But the beauty for you is you've got 46 years of real value, real track record, real proof. So as an investor, it's a no-brainer.
Well, that's what I've been trying to tell people. Thank you, Gary.
I've been in the market a long time, and to me, very few funds launch with this type of data and history that they can reflect on. That is actual real data and really already proven by their research and history. So, from a perspective, to me, this is a no-brainer for an investor.
Well, obviously, I completely agree. But now when I'm pitching, I often get the markets are different now. Everything's different. Whatever happened before is irrelevant now.
But the markets aren't different; they go up and down.
Well, that's it. Yes, I mean we launched in 1998, and immediately we're telling clients in 1999, 2000 that the dot-com bubble was there, and clients beware. We were doing the same again in December 2007, saying that the markets were too high before the crash in 2008, and in 2016 as well. We've got it all documented. It's raw data that we've captured. So can
I ask you what they're saying now about the AI bubble? or is there no AI bubble?
Uh, I I can't give you an immediate valuation because we're in the middle of a back end upgrade, you know, to the source code. So it's not actually churning out the trades at the moment, unfortunately. But
There's a lot of talk about AI bubbles, similar to the dot-com bubble. So
yes,
yeah, I'd be interested. I don't personally think it's a bubble. I don't think the bubble's even started, but who knows? What do we know? But I'll tell you one thing I do want to ask. Yeah, we talked about the data and we understand how effective the history is and the system. One thing we haven't touched on, which I'd love to know a bit more about, is how do you manage the downside?
we if if um, if our call is okay, we're 76% of the time we're getting it right, but you know obviously that other 20 odd percent is not right. But we have a we're disciplined. Generally speaking, if something's 5% wrong, you just cut it and then look at it again, because I know too many traders over the years, you know, they're classic of cut, you know, take the profits and run the losses, which of course should be the other way around.
Definitely.
Yeah, so it's the first cut is the cheapest, as they say.
Always. Tell me, Alex, when the system produces a signal, how much discretion is there involved?
I've had many conversations with risk departments about this and concentration risk in the portfolio, but generally they come to the conclusion once they understand the investment methodology of the code. We're left to our own devices, but it is we don't want the human side to interfere. You know, when the code produces the trading alert, you might try and finesse it and say, well, not today because the markets are crashing. Maybe wait until tomorrow or the next day or something. Once that happens, you're almost negating the 40 years. You know, that emotion is starting to creep in, which we really are trying to avoid. So we do stick to the code. And
Well, what about drawdowns? Is there any history on drawdowns?
I haven't had any yet. I suppose it could be quite easy if you did launch when the markets suddenly do take a bit of a tank, and we all know that they will recover. But if you happen to launch a fund right in that bad time, it is unfortunate. And I do know there's a lot of clients or funds that won't invest if a small fund has a drawdown at all. You know, even if it's 0.1%, it's a drawdown, and they just avoid it. But we haven't had that yet.
When is the fund expected to be totally up and running and fully functionable?
Well, we're 3 months into the upgrade. It is a bit of a long process. You ask the programming team when will we be ready, and you know with any IT project they laugh at you. But I'm hoping within the next 2 to 3 months, I think we'll be back up and running. Have
you started raising capital yet?
I'm trying to. You know, it's trying to rejig the teaser, for example. It's never easy to condense 40 years of historic data and a 20-page presentation into a 2-page teaser. But I think we've got something, so I will be sending that out now and trying to get some traction now.
Do you see family offices as a natural audience? And what about other funds, fund to funds? investment?
I think fund to funds probably are a good area to start. Without the lack of a proper track record for the last 2 or 3 years, and everybody asks for a Sharpe ratio or Sortino ratio or something, it's going to be a tough sell. But because of the, as you rightly pointed out, because of the decades of experience that we have in valuing stocks and the markets, I think that I'm like to think that would give us an edge.
I think also what can give you an edge, Alex, is without being too complimentary, is you're a man who's been around 35, 40 years. You're still here. Yeah. You're successful and you're moving forward with the times. That must give investors some comfort.
Well, I'd like to think so, and I drive a family style SUV, because there was a Bloomberg survey not so long ago about how do you rate your fund manager depending on the vehicle that they drive. And if a fund manager is driving a Lamborghini or Ferrari, it means that they're more prone to taking extra risk, which is not ideal. So when you got your plain vanilla Toyota 4x4, I'm a better bet.
So is that what you're driving, or are you driving a Porsche Cayenne GTS?
Quietly under the radar.
Well,
no, the Toyota's far more reliable.
So what's the next 3-month plan, may I ask, before we wrap up?
Well, I'm here in Johannesburg because I'm helping as much as I can, morally, I suppose, the IT department and the programmers. Obviously, I'm tweaking the teaser, reaching out as much as I can. When I get back to London, in the next maybe 2 or 3 months, I'll be pounding the streets and having those face-to-face meetings that I've been teeing up through LinkedIn and other avenues. And then all the structure's still in place. I still have my FCA registration, and I'm regulated obviously by them. The fund structure is still in place in Gibraltar. So we're pretty much ready to go. We just need to tempt the first investors. There is the other option, of course, as opposed to giving assets under management, is to perhaps take a percentage in the business, in the fund itself. Because we are going to grow, we are going to cover thousands of more stocks, and we are going to launch new funds. And a source code like this can be worth an awful lot of money. The only other code that I've seen similar to ours over the years is a US model, but they have 20,000 stocks on their database, and they started in the 60s, and they were sold to Credit Suisse about 15 years ago for $100 million. UBS now own them because they bought Credit Suisse, but it's the only other product that I've seen is similar, but their valuation process is not quite as in-depth as ours. So if somebody looked to invest in the business itself, they could see a massive gain on their investment in the next 3 to 5 years.
Sounds very exciting. I'm envious of your opportunity. Tell me, where do you think hedge funds are going over the next 5 or 10 years? And as we see the change in markets, the need for this historic data, a lot of funds don't really produce the returns they should. I mean, from what I see, a lot of funds don't even beat the S&P. So, what is the future for hedge funds?
Well, I think obviously a lot will fall by the wayside. The prime brokers I speak to, who every day they're approached by funds, to give them working capital, or not working capital, but AUM to start the fund. They've come with a spreadsheet, they've got an algorithm or something, and most of them are dismissed, and the one or two that are accepted. They find that for 3 months it works, 6 months they break even. By the end of the year they've lost money, and during that year they've tweaked their algo so much that they forget where they were in the beginning. And this is seen over and over and over again. So, but there is a niche for a quality asset manager or hedge fund that is active, that can outperform. And I think that will, as long as we have this passive investment, the lack of quality research and ETF trading, I think that all pushes clients towards quality active fund managers.
With the advent of AI automation, I know we touched on it earlier, and you're using a lot of technology, etc. How do you see, with that in mind and quantitative research changing, how it affects asset management going forward? Do you think it's going to change dramatically? We talked about research being done by AI, and we haven't really even started the AI journey, if we're honest. We're just scratching the surface. How do you envisage it happening? I mean, do we see a load of robots trading in the future?
Well, possibly. I think there's a lot of people out there that would love to use AI because they want to get in on the act. But to me, it's just they're just throwing darts at a board, and if some of them stick, then great. But without proper data and without proper analysis, like we have, of a company's financial health, I think a lot of them will be chasing shadows. I really do. I mean, the AI in the industry, AI is changing a lot of the middle to back end side of the industry. The custody, administration, and all those functions that happen in the background. AI will be a large part of that operation, but when it comes to actually trading and making money and investments, I think AI will just be struggling.
Just one more question before we finish. How big do you want this fund to be, and is there an optimum size? Because we often hear about certain funds, and I'm not talking about automating or technology funds or anything like that, but funds in general, where they get to a size where they actually can't use all the money they raise. So do you have in mind an optimum size for this fund?
Not really. We will always be investing at this stage. We'll always be investing in liquid assets. Although the source code is very, very good at picking today's small caps that are going to be tomorrow's large caps, it can pick those companies that have really, really consistently strong balance sheets and cash conversion ratios. But for the fund going forward immediately, we will be investing in liquid assets so we can trade easily. So there's no limit to the assets under management.
Excellent.
We can easily get in and easily get out.
So in wrapping up, Alex, and before you start pounding the streets, who should be speaking to you? What kind of investor is right for your fund? Who do you want to hear from? What should they understand before they engage with you? What is the one thing you want potential investors to remember about this fund?
I think they must just remember that we do have the decades of experience of analysing stocks. Although the source code was written in the mid to late 80s, it has been enhanced over the decades. I mean, only 2 years ago, my colleague said, well, he thinks it's 99.9% as perfect as it will ever be, but it's gone through enhancements, little tweaks, over the decades. So and that's something you can't create overnight. So we really do have something unique, and albeit it's back testing or implied returns, which a lot of people just dismiss out of hand, it is something there. It is taken from raw data. So we can prove that the system has worked and shown us the signals, say, on major market corrections or over the decades. So if somebody is looking at us now, you stop looking around, and if you've got spare money, I hear more and more today there are so many investors are sitting on so much cash these days waiting for the next right product or the right move. Deploy some of that cash with us and we can put it to work.
Fantastic, Alex. I think, really, I've been around 40 years, looked at the market. I think it's a great opportunity. If I had loads of spare money sitting around, I'd certainly put it with you.
Thank you.
For the people that want to invest and have got that spare cash, well, how can they get hold of you? Where can they contact you? What's the best route?
They can contact me on my FCA registered business, which is Kinsey McBain Capital, which I haven't mentioned up to this point. That is an authorised business, and through that they can contact me at alex@kinseymcbaincapital.com. That's probably the best way to reach out to me.
Are you on LinkedIn as well?
Yes, obviously my LinkedIn page is there. Also a good medium to use.
Can I just ask, McKinsey McBain, is that a fund manager company?
I created that with two colleagues of mine in London who I've known in the markets for over 20 years, and we are trying to create a small stockbroking business, and which the fund probably merge into going forward, but it's very early days yet. Although we have our authorization, we're still engaging with the FCA so they make sure that we're fully compliant, but potential investors can reach out to me on that email address.
Well, thank you, Alex. It's been a really, really interesting podcast. I love conversations about funds and money markets and capital markets. I think it's a great opportunity. I really am impressed, and I think data and history is key. When we see that other funds are just coming in with 2 or 3 years paper trading experience, I'd much rather look at a 40-year track record. So, look, I want to say thank you for being on my podcast. I want to say to the listeners, thank you for listening in. You know where to get hold of Alex. I think you should keep an ear open and an eye open for the next moves on this fund. I think it's a very exciting opportunity. Alex, we'll talk again in a minute, but thanks once again for being on our show.
Marvellous, Gary. Thank you so much for hosting me. I really do appreciate it.
Yeah, I really enjoyed talking to you, and I think it's very, very good opportunity. Thank you.
Thanks, Gary.